All right, hello and welcome to the Charter Cities Institute's quarterly digital roundtable. These digital roundtables seek to promote conversation and provide introductions among relevant stakeholders who are engaged in some facet of new city development in Africa, including but not limited to investing, building, hosting, and governing. Today we have auctusESG. We'll start with a round of introductions. I'm Carl Peterson, the Senior Manager for Special Projects at the Charter Cities Institute. When I call your name, please tell us who you are, your institution, and your role there. I'll start with the CCI team before moving on to the Auctus team. So, Mwando, would you please introduce yourself?
Yes, thanks, Carl, and good morning, good afternoon to everybody. My name is Mwanda Piri, Africa Lead for the Charter Cities Institute.
Cisco.
Hi, everyone. I'm Siska, and I'm Carl's intern for the Special Projects team at CCI.
All right, Sourajit.
Hi, Carl. Hi, everyone. I'm Sourajit from auctusESG. We are a sustainable finance and climate risk advisory company working predominantly with financial institutions across developing countries. Good to connect with all of you. Thank you.
All right, Rashika. Rashika,
You're on mute.
Rashika, you're on mute.
You're mute.
Okay, I'm sorry. Hi, everyone. I'm Rashika. I work at auctusESG. I am currently in a role of senior associate. I work with Sourajit. Thank you.
All right, Charu.
Hi, hello everyone. My name is Charu. I take care of communications at auctusESG.
All right, Martin. Martin.
Oh, sorry. Hi. Yeah. Hi, Carl. Yeah, my name is Martin Reed. I'm a director of West Africa Free Zones, and we're trying to develop a free zone in Nigeria.
Great, Emmanuel.
Hi, everyone. Nice to meet you. My name is Emmanuel Akwa. I'm the CEO of Africa Center for Entrepreneurship and Youth Empowerment, a think tank based in Accra, Ghana. Thank you.
Caesar.
Hi, this is, my name is Cesar Ramirez. I am the chairman of Barcelona Housing Systems. So we are a technology provider for large-scale projects on housing.
Kirk.
Hi, everyone. Good morning from North Carolina, beautiful North Carolina. We're experiencing a little weather condition here, offshoot from the hurricane. But I'm Kirk Hilton with Maroon Associates, and we're pleased to be attending this meeting. Thank you.
Donald.
Hi, Carl, and good afternoon. This is my afternoon to everyone. My name is Donald Klaga. I am the chapter lead for the Center for New Liberalism Johannesburg chapter. I'm based in Johannesburg. Thank you.
Great. And did I miss anyone? No? With introductions out of the way, I will hand it over to the team from Auctus for the presentation. And Rashika, I think you should already have sharing abilities.
Thank you, Carl. While Rashika tries to get the presentation on, just to start off, so we've been working across sectors. We're a sector agnostic company, but to the best extent possible, I've tried to sort of create the presentation focusing on infrastructure, climate resilient infrastructure. I believe there's a Q&A session at the end, so do let me know any questions you may have on the content as we go along, maybe at the end in the Q&A session. So bottom line is on the topic of sustainable finance and climate resilient infrastructure. In fact, the sentence that I think Kirk was it from North Carolina, I think he pretty much hit the, the nail on the head that extreme weather events are changing rapidly everywhere, and in almost every part of the world, we are literally witnessing a lot of difference in the way the weather is playing out, and that the consequences on business and finance, while that is not visible always. That is not visible at the very, start. But slowly but surely, we've reached a stage where it is becoming apparent. The connection between the two is becoming apparent. And that is really where, when we talk about future investments into the SDG sectors, especially into infrastructure, which the developing world needs acutely, there's a huge shortfall of it. Going ahead, we would need to be mindful of these emerging risks that are bound to affect the business and the financial landscape. And how do we really channelize finance in this context? So let's move to the next slide, please. So a very quick glance, I just wanted to put out some, this is hard data, this is science. I mean, we do have a lot of criticism against the sciences, but that said, there are a lot of notable institutions who are recording these information, and I think the data is a good way to start. What we're really trying to do here is look at the emissions intensity. So emissions intensity gives you a sort of an average or a ratio of where does in the pecking order of things, where does the economic size match up with the emission size in the market in that particular country. And you will see that on the left side of the screen, a lot of greens and a lot of reds, which is essentially the Asian markets, the African markets, who are, yet to come up the curve in a large way. There have been improvements in several of them, no doubt, just to acknowledge and just to be fair to that. But at the same time, you have to remember the law of arithmetic here, because most Asian, African developing countries, and I will concentrate more on that section of, of the global economy. They're on a chart which is pretty much high economic growth chart. They need to create the jobs. They need to grow that infrastructure. They need to grow all those opportunities. Now, all that activity comes at a cost, and one of the cost is energy use. One of that cost is industrial processes, which cause emissions. And that is why emissions are only bound to increase before they, in fact, start peaking and tapering off in several of these green and red countries that you see. So that's a cause of concern, and that also gives an indication of where the risks really lie. And projects in those sort of markets would need to be considering the climate risks, both in terms of physical and transition risk of climate change. Moving to the next slide, please. So obviously some contextual issues, some of them I've already spoken, that a lot of these markets have the necessity to keep up the tempo or the momentum in terms of GDP growth, jobs growth, infrastructure growth, so on and so forth, which would translate into an increase in greenhouse gas emissions. At the same time, a lot of basic access level to services, energy poverty, etc., sorry, is still lagging in many of these markets, especially when you go outside the larger cities. You also need to remember that, with the increasing cost of production in many OECD countries, a lot of those manufacturing processes are getting outsourced out to the developing world. And the question now really is that how does that impact the overall scheme of things in terms of the infrastructure there and the overall emissions profile in those countries? So it's really a question of not just offshoring out the economic activity, but also offshoring out the emissions because of that economic activity. And last but not the least, we are at a stage where a lot of countries, a lot of companies across the world are aligning with global pledges, commitments around carbon neutrality, around net zero transition. And, in order to remain relevant in the global supply chain, in the global capital flows and so on, those commitments are necessary. But then how do you balance those commitments with point number 1 and 2 that you see on the screen? So that's really what the contextual issues are in some of these countries. Let's move on to the next slide, please. So very, very quickly, I personally, if you ask my personal opinion, I don't take much value on numbers, because these numbers will differ from report to report. But what the basic message here is that obviously there's a huge infrastructure investment gap as far as especially as far as the developing world is concerned. And that gap is pretty wide, and that gap is becoming more difficult to fill by, every passing year, because we have new type of risks that are emanating out and affecting how we look at projects. And one of those risks is related to sustainability and climate risk issues. So that's really the broad message I'll want to give in this slide. Let's move on. Okay, I'll spend a bit on this. So this is really what we would, in a very nutshell, how we would be looking at the integration of a climate risk layer or the consideration of a climate risk layer in normal project financial analysis. Most of you would be familiar with how typically project finance is probably looked at. When we are looking at sustainability and climate resilient technologies, if you start from the top of the circle, so obviously a lot depends on which are the technologies that are easily available, that are affordable, that are credible, that are reliable, and what is the cost of that of those technologies, and how do you integrate those technologies into the project design phase, into the detailed project reports, feasibility studies, and so on and so forth. Now, the question here really is about measuring that risk, and that is really where a lot of controversy as well as a lot of debate and discussion happens in the market. Because if you see at the third circle on going clockwise, how do you measure disruptions to business continuity or damage to fixed assets? Because that's really how one of the essential ways in which the physical risks of climate change really transcend into the impact on the business community, and eventually, because of that, the impact on the financial community. So what it really boils down to is how you approach circle number 3, and basis how you approach circle number 3, that particular risk that you estimate, whether because of sustainability issues, climate issues, how do you integrate that into financial risk? Now, here I want to make a very, because this is a myth that we often hear in the market, and I want to debunk that myth in case there were any of our colleagues here who had maybe that confusion. There is a difference between making ESG sustainability reports for the sake of data disclosure vis-a-vis using that data towards understanding what risks it exposes you to and how you manage that risk. And that is why when we hear that ESG is a disclosure item, it's about disclosing the numbers in a report, in a fancy report with nice looking graphs. That's not really what ESG is all about. In fact, that is one of the reasons why ESG performance doesn't really hold true in the market, and you have the anti-ESG movement in many countries. So what it really what ESG is all about, it's an assessment framework to understand, measure, integrate, mitigate ESG related risk issues to mainstream business risks. That's what it boils down to. And if it affects your business risk, eventually it will affect the financial risk. So it's not about including data as a screener. It is about including that risk issues into your entire risk analysis. That's what ESG is all about. So that's the fourth circle that you see in the clockwise direction. Now, basis the risks that you have estimated for a particular project, let's say a project in North Carolina for sake of assumption, and there is a infrastructure project, a bridge or whatever, some building project that is coming up there. Now, basis the risks and climate-related risks that you have measured and the available technologies that are there, the next question is the fifth circle on the screen that you see, that what would be. So typically a project finance has terminologies called hurdle rate, internal rate of return. And the idea is really that if my risk is increasing, then the cost of capital of financing that activity will increase. And therefore my hurdle rate, which is the basic rate that I need to achieve for my investors, will need to increase. And hence, therefore, the internal rate of return that I would want to earn over and above the hurdle rate would need to increase. So that's really the cycle of things. Essentially, the question really is here, to what extent do we increase that? And therefore, we need to make a reasonably good probability-based assumption of that risk factor. There are a lot is still evolving. And hopefully, as years progress, we'll have better financial hedging tools out there. The next aspect to look at is really what does it mean so any project is being done to earn revenue. It's being done to earn cash flows. it's essentially being done to create an asset that will create cash flow. So let's say a highway toll project, or let's say a building project that will earn rental. So what is the cash flow stream that would come from that project, and how does it compare to the incremental cost of that project, which is what we have been talking about in the initial 4 or 5 circles. If there is a way we can create demand assurance, so let's say even before construction, I mean, the best case scenario in a building project, I think every real estate developer would have loved this. Even before construction starts, if all the apartments in that block are already booked by prospective customers. So that's the ideal case of demand assurance. And what that helps is it helps you to factor in your cost and revenue, estimations very nicely. Now, basis the increased cost, basis the revenue flow, how do you actually raise the funding? So this is where really when we talk about infrastructure particularly, there's a lot of conversation. How do you get long-term patient capital like pension funds, sovereign wealth funds to sort of come in? Because they would typically, I'm using the word typically very carefully here, typically commit at a lower cost of capital, and that would sort of adjust your project's cost of capital to a lower rate than what it would otherwise have been had it been completely at market rates. So because as let's say you put yourself in the shoes of the CFO of that project, you want to reduce the cost of that project ultimately and the cost of financing that project. So how do you get the sort of investor profile that would probably bring in more stable long-term funding flows, but at the same time it would come at a lower cost of capital that would sort of reduce or keep your weighted average cost of capital adjusted for climate risk within control, within limits. Another way of looking at it is how do you really combine public-private partnership models? And this is really where you sort of make tranches of capital. So let's say if I want to invite private capital, I try to give it a senior tranche and maybe give the public capital subordinate tranche so that the private capital's risk perception reduces to some extent. Again, public capital often comes at concessional rates depending on source to source, and that can really adjust the cost of or the overall cost of capital of the project to some extent. There have been some conversations about using blended finance. I think blended finance is a very misused terminology in sustainable finance debates. But we'll talk a bit about later or maybe in the Q&A about what are the particular situations in which blended finance is usable and in what situations it is not usable. Blended finance goes way beyond public-private partnership. The two are connected things, but actually very different things. And the idea again here is to how do you create a structure that keeps your cost of the capital under control. So that's really a number of issues that go into the mind of the financier when he's looking at a project, especially a project from a sustainability or a climate risk lens. And as whether you are a project developer, whether you are an intermediary, whether you are going to utilize that infrastructure or going to fund that infrastructure, irrespective of what your role is in the scheme of things, it's always useful to sort of put yourself in the shoes of the financier and try to gauge that what is it he or she would be looking out for. And this, I think this slide largely summarizes that. Let's move to the next slide, please. So going ahead, what are some of the things that we can just keep in mind or we can suggest to policymakers or industry practitioners that what can be done? So on the policy side, what are the policies that can create? So when I say green capital flow, what I really mean by that is there is a asset class of investors coming up right now, mostly in Europe, obviously, who are dedicatedly investing in green projects. So it is called dedicated green capital. And the idea is that how do you get that green capital to flow more into projects in the emerging markets, in the developing countries, despite the country risks? How do you hedge for the country and the political risks to enable that green capital to come? So what are the supportive policies required? What are the supportive policies required for sovereign-led funds and incentives to come in? What are the policies required to ensure commercialization of a lot of innovative technologies that are happening? There's a lot of innovation out there. I think the human race has gone leaps and bounds in searching for innovative solutions for a low carbon model. The question really is, how do we scale them up at a commercial and affordable rate? So that's really where policy incentives are required. And nevertheless, last but not the least, the just transition issue, especially in developing countries where obviously a large part of the workforce in erstwhile carbon-intensive assets might get redundant. It's easier said than done to talk about, we need to reskill them, we need to reabsorb them. That might be easy in several countries, but in the developing world, that's extremely difficult. So how do you actually create a supportive policy towards just transition of those redundant people? Because do remember that most of the population, global population, is residing in the developing countries. Another quick aspects on, so it goes back to that third circle I showed you in a previous slide, that how do you actually go about measuring, identifying and measuring, scoring climate risk? Because these approaches are really evolving. There are approaches out there. I mean, we can talk in the Q&A about that. But the idea is really that there is no one set method. Everyone is using their own approach to based on what is best, most doable in their context. And that is something where probably if those processes become more fine-tuned, more evidence-based, then that would increase the credibility of the project and eventually the bankability of those projects. Of course, third-party impact assessment, that whether those technologies, whether whatever other additional interventions being done in that infrastructure project, whether that is going to have that impact, the expected impact or not, is part of this, as is the capacity addition. On the third column, so products, so I have a personal sort of a favor towards performance-linked products rather than labeled products like green bonds and all, because as a product, green bonds and all have a lot of restrictions, especially in context of developing countries and their on-ground realities, the way those economies are, the way their markets are, the way their sectors are. And performance-linked products have, in fact, which are called sustainability-linked bonds, sustainability-linked loans, outcome-based financing. I've been involved in, before I joined Auctus in a previous organization, I was involved in a impact, pay for success impact performance product itself. And in the last 2-3 years, we've seen this space pick up a lot in the developing countries. So I think this is really where the future lies in terms of sustainable financing, enabling sustainable financing flows. And that's something to look out for. The point on blended finance is something I spoke previously, that it really depends on the situation. It really depends on the particular context of that project, whether blended finance is usable or not. Risk hedging tools, carbon finance, obviously risk. So one thing you need to remember is that while insurance is the most common hedging tool that everyone on earth, I'm sure, has heard of it. But insurance, the concept of insurance is really based on the actuarial sciences is based on the concept that there may be some risk incident that may happen. It may happen very frequently, but if it happens, it will have limited damage. So insurance covers are typically created for those sort of risks. Climate risk is the opposite. Climate risk climate risk event may happen really once in a rare case, but when it happens, it will create a huge amount of catastrophe. Like you often hear the news, not just in Florida, Alabama, North Carolina, South Carolina, Georgia, but also in several other countries. I doubt if there's any country in the world that has not been affected by these sort of issues. The syndication of foreign and local FIs, in my view, is a very important point because there's a lot of domestic capital residing, but that capital does not really get channelized towards sustainability business ventures. A lot of that sustainability business ventures are dependent on foreign financial institutions, which obviously are limited in what they can do in the developing world due to country and political risk issues. So there's a lot of syndication or what is called consortium lending that is required between domestic and foreign agencies to sort of work on transactions together and enable that capital to flow. So that's really what I wanted to say in this slide. Let's move to the next one, please. So very quickly, I think we just have about three minutes or so. Very quickly, I'll just go on some of the examples. So some of these terminologies that I just used, PPP, public-private partnership, blended finance, impact bonds. So just to put them in context of some infrastructure or energy projects, So an example of PPP funding in Uzbekistan, which is one of the most climate vulnerable countries in Central Asia. So wind power project basically brought in public and private funding from the multilateral development banks, from bilateral DFIs like FMO of Netherlands, like I believe JBIC of Japan, some private sector banks like Natixis and others, which was backed by a partial guarantee component to reduce the perceived risks. There was an additional credit facility to pay the VAT particularly, and certain procurement practices to sort of manage the cost escalation due to inflation. So this entire package of different financing routes to address different risk issues in the project really helped to create a structure where you had concessional lending coming in, you had credit enhancement tools coming in to reduce risks, and ultimately the project was helpful to yield avoided emissions because it was a wind energy project. It reduced the need for normal thermal power. So the avoided emissions in this case was significant in that country, not to mention the energy access. In the same way, climate fund managers of Netherlands, I believe, launched a fund called Climate Investor 2. Now, that was really structured as a blended finance structure to allocate private equity in certain key sectors. And the way the funding was sort of created was in three tranches. So a development fund was created, which was donor funded, which was created to cover the planning costs of the project. So basically enable project preparation or project, a lot of documentation, the preparation of a lot of documents, etc. So that technical assistance came from there. The construction equity fund was a separate tranche within it to cover the construction costs, and then eventually the credit fund itself. So this sort of a structure or a tranche-wise structure really helped attract institutional investors to invest in certain pockets of requirement or certain use of proceeds, if I call it that. And that sort of created a enabling structure to fund the entire program. Let's move to the next slide. So Washington, D.C. Water Authority launched a first of its kind environment impact bond. Now, impact bond, this is what I was talking about, performance linked pay for success model. It was one of the first in the water, sewerage, water and stormwater drainage space, especially to sort of control the flood risk or improve the flood resilience in that region. So Goldman Sachs and Calvert had funded this particular bond. It was a private placement bond with the two financial institutions. And the performance metrics here was really based on how much is the change in the water runoff limits. So if the water runoff due to improved sewerage pipe and drainage network, if that thing improves, then there is a contingent outcome-based payment that was linked to that. This was created as a municipal bond because it was under the municipal authority, the water authority in Washington, D.C., and essentially combined green infrastructure in what is otherwise gray infrastructure. So combining green aspects within gray. That is why it's called. So if you see the last line, a number of things like rain gardens, green roofs, permeable pavement. In fact, closer home to North Carolina, in Florida, in Miami, the city of Miami sometime back released a flood resilience bond that was also structured very similarly to this particular transaction. So these are interesting models that have come out there. And again, I will reiterate that the performance-linked model, in my view, is probably the future as far as a lot of developing countries are concerned. The last but not the least, in the Philippines, closer to Asia, a green bond structure created by the energy utility. So this was one of the important points here is that it was a local currency denominated bond, which is often a big challenge in developing countries because of the perceived currency risks. In fact, in auctusESG, one of the first projects we worked on was in Zimbabwe, where the currency itself has changed 3 times in the last few years. So the currency risk issues is as big a problem as country risk and political risk. And that's why the currency really makes a difference. But then because of partial capital account convertibility or partial availability of foreign exchange, the ability of the local companies to raise dollar-denominated bonds is often restricted, and that is why local currency denominated financing is always preferred. In this case, it was really to fund the resilience of certain electricity plants that had been damaged by an earthquake and several extreme weather incidents, and was quite an interesting example of how the local currency market can be mobilized towards disaster resilience. Let's move to the next slide. I think that was the end of the PPT. I'm not sure if we've overrun the time, but yeah, over to you, Carl. Thank you.
No, that's great. Thank you very much, Surat. So yeah, I think we'll open up the floor for questions. So are there any initial questions that our audience would like to ask? I have an initial question. So you were discussing sort of briefly blended finance. So certainly in my experience with all of our projects in Africa here, blended finance is the number one thing that comes up in addition to public-private partnerships. So can you go ahead and expand on your concerns regarding blended finance and not always, not often being the right answer?
So the reason I say that blended finance is probably not the thing in every case is because blended finance, the terminology, when we interact in the market, we find that it's being used for anything and everything. So it's the exotic term of the day, and it's being used for anything and everything. And the logic, so in a very nutshell, the logic of blended finance is point number one. It is a structure that is enabling financing in transactions that would otherwise not have been financed under conventional channels. So if there is a project that would otherwise have been funded under conventional finance, PPP structures, this, that, whatever, and you are using blended finance for it, then that is misallocation of capital, point number one. The reason that is the cases like that is because blended finance is really an SDG financing tool to enable development towards certain communities that have not been getting, certain essential development goods or services, to create access for certain new development technologies. So let's say a lot of low carbon innovative technologies that are otherwise not bankable under conventional finance, or in certain regions. So let's say in the hinterland of Africa or countries in Asia where conventional finance is often resisting from entering because of perceived risks. So to bring those elements, those demographics, those regions, those interventions into the financing stream is what blended finance is to be used for. It's not meant to be used for anything and everything. If I give you a very simple example, women owned interventions in a rural region for using decentralized solar. Now, in most countries, women are often perceived riskier from a credit history track record for various reasons. Although microfinance proved that wrong. Secondly, decentralized solar is still in early stages. It's perceived risky by conventional banks. But at the same time, women have proven to be successful micro entrepreneurs in rural regions, bringing economic empowerment. So how do you actually fund energy access for them? The moment they get access to energy, they can power their shops, they can power their small businesses, they can do what they have to do. That activity may not have been funded under conventional financing banks and all that. And that is where you use blended finance. So it's about that, creating that element of impact. It's about bringing in public and private in a way that the risks are reduced and the private capital can be in multiples. But the bottom line is it's to be used in areas where conventional finance otherwise would not have ventured. And that's really the point I wanted to make, that why blended finance is not the solution for everything. It depends on the context.
Great. Wanda, do you have a question?
Yes, thank you so much, and thank you for the presentation. Two quick ones, sorry. I mean, there's this basic argument that, ESG considerations, issues to do with sustainability, often lead to inefficient capital allocation. There's been underutilization. I guess it's a requirement to sort of, prove that indeed your projects are green or sustainable. Do you have a comment around that? And then second, as auctusESG, I may have missed this. Do you also facilitate, access to potential financiers? Say you have a city project and certain infrastructure in there, will be sustainable, could be renewable energy. Do you play any role of maybe facilitating introduction to green financing, presentation of particular projects to see if there's any interest from investors? Thank you.
Moanda, I'll request you to just maybe ask your first question once again. I was not clear exactly what it was. Yeah.
No problem. Sorry, I was just saying there's this basic argument and push against green financing that comes from this idea that it leads to inefficient capital allocation. There's a lot of capital that hasn't been allocated, assuming it's the requirements to sort of, prove that indeed you're meeting the various metrics to show that a project is sustainable. I just wanted to get your comment on that. And then if you need me to second one, please let me know.
Yeah, so thanks, Moanda. So, the answer to that question is actually in two parts, if I put it that way. So first part is, how do we actually make a reasonable measurement of sustainability or climate risk issues to a particular project? And if you Google out, you'll find examples of a lot of projects that have been impacted by climate issues. I think the biggest examples are in California and the US. You don't even need to look at the developing world. It's not something that is far away in Asia or Africa. It's very much happening in the US, impacting US institutional investors. So a lot of examples have occurred in the past in California, of all places. And the cost of capital controversy here is really about, if there is an increased risk, then obviously the investor needs to be safeguarded for that risk. And therefore, what is the incremental cost of capital, or what is in financial lingo that is called spread, but essentially, cost of capital, which is what I was showing in that graph with all the circles. So it's about pricing that risk so that your project is efficiently priced. The project cost is efficiently priced. Now, that is something that is a process in transition right now in the industry, because obviously different banks are trying to develop their own approaches. They're trying to figure out what works best. At the same time, nobody wants to let go of the business. Nobody wants to say no to business. So they still take on transactions. And when certain situations of examples have happened, I'm taking the examples from California only, then those investors or those banks have obviously lost capital. There's been write-offs. The second part of that answer is that if you actually think about sustainability, climate issues, risks being as much a mainstream business risk as any other business risk, let's say I don't have a credit history track record. I'm a business risk when I go for a loan for a bank. I take a car loan, I drive like a maniac where the insurance won't cover. I am a business risk for that bank, So just like there's every other business risk, if you actually factor sustainability and climate risk issues as a business risk, then effectively the adjusted cost of capital becomes a right cost of capital. And therefore the cost of capital at which the bank is lending right now is the misallocation of capital. So it's the other way around. I'm just putting that picture. So we are often debating whether adjusting for sustainability issues is misallocation of capital or the right way is or not. It's actually not accounting for it eventually will probably prove the misallocation of capital if you look at it that way. So it depends how you look at the situation. Needless, what I'm saying is obviously from a debate standpoint, but in terms of the real aspects in the industry, of course, things are evolving. Things are, it's an industry in transition. So, things are continuously happening as we speak. Things are changing as we speak. On your second question, yes, again, answer in two parts. We, amongst the various work that we do with financial institutions and organizations, there are two things. We work on them on advisory projects to enable better preparedness to be able to raise green capital. Every organization as it is now may not be in the right, be in the right place to be able to raise green capital. It doesn't happen that way. You have to do certain things in your organization to sort of tick the boxes and ensure you are right, you are able to raise that green capital. So that's one thing that we do. The second thing, we do not have proprietary capital, so we do not invest directly, but yes, we have, we have connections with the investor and the banking community, and happy to make any connections if required, depending on the needs of the project.
Great. Do we have any further questions? Yeah, Emmanuel.
Okay, thank you very much, Carl. And thank you very much for the presentation. So my question is, we are currently conducting one of our research projects, and per my observation, so I visited a couple of markets here in Ghana across the 16 regions. And one of the difficult things to come by is to find local innovations. So we are, as a country, I would say production is quite low here. So you'd find it would be difficult to find innovations owned by indigenous people. Now, with the urbanization drive that's taking all over Africa, and for my country, Ghana, you also know that there is also, should I say, a conversation about manufacturing and all. Now, that being said, how or what recommendation would you give to stakeholders such that in as much as we are promoting the urbanization drive or in a quest for sustainable cities, how do we find a balance in ensuring that, yes, there is an urbanization drive, but at the same time also there is some urbanization is also pushing for economic prosperity of people.
Emmanuel, the question you've asked can't be answered in 2 minutes. It's actually worthy of 1 hour of discussion, to be honest. There are a lot of interconnected factors. See, most city planning has always been on legacy infrastructure. So that's really a huge restriction in sense of what all you can do in a given point of time. So I think the first message in any city transformation, sustainable city transformation you need to keep is, it's going to be a long drawn process. It's not going to happen in a few years. It's going to take a few decades. But the question really is, what are the things that we can do? So in case of smart cities, you see a lot of digital infrastructure being laid out so that a lot of city services, public services, utilities can be provided very seamlessly. A lot of that usage, which otherwise there is theft in the system. Electricity theft is the biggest example. How, you have a lot of smart meters coming in. So you have a lot of digital related infrastructure that is coming out to make smart cities, sustainable cities. You have a lot of green cover that is coming up in places. You go to Singapore, I think that's the best example of how they have used the vertical garden concept in a cityscape to sort of create green lungs within a restricted space. So you have these, but at the end of the day, these are all what you call little bits and pieces here and there. The basic infrastructure, the basic roads, the basic, bridges, the basic flyovers, the basic buildings are still there. You do have the push towards green buildings, which is an encouraging sign. Green buildings as a sustainability segment has been increasing leaps and bounds, as is electric vehicles. So those are encouraging signs. But obviously, a lot of the legacy infrastructure, a lot of the legacy concrete, a lot of the legacy steel is still there. The new innovations in green steel recently we were talking to someone and they're trying to put together a net zero concrete initiative. For instance, you have these sort of initiatives coming up where a lot of companies are trying to innovate and create new. But green steel and all that, it's still a long time away. It's still not, I mean, there are 1 or 2 use cases, but it's still, in reality, it's still a long time away. So there's the idea really what I'm trying to drive is there are those small things, better resilience, to create better green cover, to create better digital services so that, the cities become more efficient. But at the same time, as and when the legacy infrastructure is to be replaced, that is really where you need to plug in the sustainability variants depending on what technologies are available at that given point of time.
Okay, thank you very much.
Do remember that I'm adding one more issue here. This is a developing country issue where in most countries you would have found that the cropland area is decreasing. There's enough articles how not in several African countries, Kenya, Tanzania, in fact, in Asian countries like India, cropland is actually reducing due to degradation and desertification for chemical fertilizer. While the populations are increasing, Africa is the best example. It's going to be the largest populated region, or if not already, right? So you have more mouths to feed and less land to grow that food on. And because of those climate disasters that happen, because the rural communities are already on the bare minimum income, when that gets rattled, then there is climate distress migration. That adds to the urban population. That adds to the unplanned squalors that you have. So creating sustainable cities is not just about the cities, it's also about creating sustainable rural areas so that the dependency or the distress migration from rural to urban also reduce.
Okay, thank you.
Do we have any further questions? Martin, you have a question.
Martin, you're on mute.
Yeah, Martin, you're muted.
Yeah, so you would have thought the COVID era would have trained me properly, but yeah. So to what extent does describing your infrastructure project as being green, to what extent does that open up more financing? So to what extent are investors only allocating money to green, to ESG related projects?
So, Martin, yes and no, in the sense that going green is right now the way things stand. I'm saying right now the way the finance structure is, because obviously majority of the finance is still conventional finance. It's evolving. The green finance space is still pretty small. So as far as currently the scheme of things are, a green project will actually struggle to raise funding as compared to a conventional non-green project, obviously, because that's where the supply of money is more for the non-green one. But that is evolving, and I think you see that evolution that evolution has already started happening in a big way in Europe because of legislations moving, because a lot of investors have moved in line to sort of create their portfolios dedicatedly towards green. There's a lot of debate about that, but at least the uniform definitions with the taxonomies and all those sort of guidelines at least give some credibility to the thing. That said, in the Asian African world, I think the best example is Singapore. If you look at the Singapore's transition taxonomy, that's a very, very detailed, effective document of what is allowable, what is not allowable. It does help Singapore that it's just a tiny city state. But if you actually look, the small countries, small city states have their own problems. Just like the Chinas and the Indias have their own problem, Americas have their own problem, the small countries have their own other problems. So I think the Singapore example, and that is something that is being extended to a larger, as what is called the ASEAN, the Association of Southeast Asian Nation region, the ASEAN taxonomy, it's been extended to. And so you have those movements happening, which will typically be the precursor to driving the flow of finance towards those avenues. So today, DBS Bank, which is one of the largest Singaporean banks, has already predominantly started moving its portfolio towards green. And in coming time, hopefully you will see several other institutions happening. In Africa, you have, of course, South Africa has been a leading market in this space in the African region. Nedbank, First Rand Bank, Standard Bank have all been doing work to greater or lesser extent in this space. But now you have a lot of movement happening in the Kenyan banking space, NCBA, KCB, you have Axis Bank in Nigeria. A lot of banks have pushed up their work in this space, obviously still nascent, obviously not as big as the conventional financing piece. That will take time, but the movement has started. That's what I would want to say.
Thanks. Yeah.
And a lot of the also, what is also happening is traditionally the banks have raised money from depositors. the people like you and me. But because in a lot of developing countries, till some time back, before their economies opened up, before when the economies were more restricted, there were fewer products and services out there. McDonald's was not there, believe it or not, till 25 years ago in India, for instance. I'm just taking a very basic example. And I'm sure several other cases like that. So earlier, people didn't have that much place. I mean, you'll laugh if I say this, but people didn't have that much of space to spend money on. So they saved. And a lot of that money went into deposits. So the banks were not dependent on external funding to raise money. They had more than enough depositor money. Now the situation is different. Now those economies have opened up. Everyone's lifestyle aspirations has increased. People spend more than what, let's say, our parents or grandparents' generation used to do. And because of that, the consumption portion of the GDP has shot up like anything. Biggest examples are Pakistan and Kenya in the developing world, amongst the larger emerging markets. It's more than 85% of their economy. So now you can see that the savings rate has suddenly shot down in most of these markets. The savings rate shooting down means that bank deposit is one of those saving avenues. So obviously the flow towards bank deposits is reducing, especially because the interest rate you earn on term deposits was anyway less than, let's say, equity portfolios or things like that. So now the banks are dependent on external funding. So the banks are going to World Bank, they're going to IFC, they're going to, a lot of foreign agencies, Japanese agencies like JBIC, JICA, and others, ADB and all, AFDB in Africa. So they're raising funding, and those funding agencies, multilateral funding agencies, are putting the criteria on them that if you want our funding, you better put in place environment, social safeguards. How do you account for these risks? How do you account for that, these issues, etc., etc.? So that's also driving so sorry, I took a bit of time, but actually, I just wanted to make the point that this is how things are actually interrelated to each other.
Great.
So I have one final question, Sourajit. You mentioned over the course of a couple of your answers, one, the infrastructure required for new cities is kind of maybe inherently not environmentally friendly. So do you think that lifting people out of poverty and economic growth, are these inherently in conflict with the environment and environmental cause?
So if Carl, I was once making a presentation somewhere, and I wish I had that slide. I deliberately put a slide in the appendix that showed how America's per capita income has moved from 1776 to now, and when it is that a lot of the inflection points in terms of energy self-sufficiency, in terms of transport self-sufficiency, in terms of per capita income becoming above an acceptable level happened. And I think that was a very interesting example. Of course, times were different. That was a different time. This was a different time. It's an apple to orange comparison. But what I'm trying to really say is at the risk of sounding controversial, sorry for that, but that's the reality. If you have a country where a large portion of your population is not getting access to basic services, who is poorer than I forgot the proverb, poorer as a dormouse or something, if I remember the proverb correctly, but essentially very, very low per capita income. There's only that much you can do to bear the cost of sustainability. So that's where the support is required. That's where public funding is required. That's where subsidies are required. That's where incentives are required. And that's where the cost of alternate products related to sustainability need to reduce. In a lot of developing countries, the cost of an electric vehicle for the same specification of a car as a normal car is far higher. A person with limited income in his pocket, a middle class population person, cannot really bear that additional cost. So that's a very simple example. So technically, to answer your question, is it against? No, it is not against. I think very much, economic growth can be achieved through the green economic growth, if I call it that, the sustainable economic, in a sustainable oriented economy, there is ample growth. There is ample opportunity to make money. There is ample opportunity to pull people out of poverty. There's ample opportunity to create national wealth and income. The question is, getting on that path is going to be a tough journey in the interim. And there will be certain costs to bear, and there will be certain time overruns to bear, to be very real, because you can't expect a country like, let's say, I believe you mentioned you were in Tanzania, if I remember correctly, or I'm originally from India. You can't really expect countries like India or Tanzania to move so fast on a transition pathway as, let's say, Sweden or a Denmark. It's not going to happen. So we have to keep that in mind, and we have to be ready to accept that, okay, there will be different pathways for different countries. The question really is, are we starting on that pathway or not? That pathway is profitable. That pathway is good business. That pathway is good for environment and society. But the question really is, are we starting to move, or are we just sitting and debating, is it going to happen? And you see that in political debates a lot, which is why, frankly, the political debate around it sort of causes me a lot of irritation, because we're not able to see beyond and see the larger picture, the long-term picture, that there is an opportunity to be had, business opportunity to be had through all this.
Great. Do you have any final thoughts that you'd like to leave us with?
Maybe before he does, Carl, sorry, so one quick question.
Sure.
Thank you. So I wanted to find out, on average, and I could have missed this during your presentation, is the cost of capital higher or lower for green financing versus, say, traditional or conventional financing?
So that's what I think in your previous question, and also to Martin's response I was making. So right now, the way things stand, obviously the cost of capital in most cases, maybe not all, but in most cases, it would be higher for a sustainability project, because the risk perception is higher, because it is something over and above what you normally accounted for when you looked at credit risk. So when you were analyzing credit risk otherwise, investment risk otherwise, till date, in the conventional system, you looked at, let's say, risk A, B, and C. But now you have an additional risk D coming into the equation. So obviously your overall risk is increasing and your cost of capital will increase. The point I'm trying to make is that eventually, as things move down this line, eventually, as and when risk D is accepted as the status normal, and technically your business risks are compiled of A, B, C, and D, then that becomes the normal. And as more and more capital flows into that space, the supply, it's a demand supply equation. As the supply increases, the cost of it will decrease, right? So eventually you'll find that the cost of capital that was right now perhaps going up will actually reduce. I will urge you, in fact, recently we were fortunate to meet that gentleman in London. You can read up his research online, Girish Srimali of Oxford Sustainable Finance Group. They've done fantastic research on the impact of cost of capital due to climate transition issues. And they have brought out a report. It's available in public domain on how it moved in the US and EU renewable energy sector. And it sort of, highlights the trend that if once the time evolves, like in Europe, you have that a large chunk of finance moving towards green. So the cost of capital there has eventually now tapered down. It's now as competitive, if not cheaper, than conventional in case of renewable energy. So you have those examples as well. Obviously, Asia and Africa is still some distance away from that. But I mean, let's use that as an example that's how things may move.
No, thank you so much. That was helpful.
Ultimately, everything is a question of demand and supply. It all boils down to that. It's all a question of demand and supply.
All right, thank you.
Great. So we're just about out of time here. Are there any final thoughts you'd like to leave us with?
No, I think that's fine. Thank you, Carl. Thank you, Siska.
Awesome. Thank you very much, everyone. We appreciate it.